Hi, my name is Bryn Evans. I'm a private wealth advisor with Integro Private Wealth. I'm joined today by Phil Andronico from InvestSense. Phil sits on our investment committee and provides some support around portfolio construction and asset allocation. Phil caught up with my colleague Tim Sullivan last week and gave an update regarding some recent market volatility relative to the positive performance that we've seen over the last few years. Today, we wanted to discuss more around clients or investors who might be looking to get into the market with cash from a liquidity event. But for the purposes of a recap from last week's session, Phil, can you provide a bit of an overview of what you covered off with Tim?
Certainly, Bryn. Look, I think what Bryn's sort of filling in there is obviously if you've been an investor who's experienced sort of great returns over the last few years, in the context of more recent market volatility, it is sort of fairly insignificant. And you can sort of see on this chart here, this just shows you returns for calendar year 2024 and a little bit of this year. And you can sort of see the great returns that were experienced over 2024. In particular, the US and tech stocks, dragged the market higher. They were sort of the best performing sectors. But, even outside of that, other sectors such as global small companies, emerging markets, Europe, Australia, Japan, all experienced double-digit returns. And if you actually did this same chart for 2023, it was a very similar picture. Tech, the US was sort of the standouts over that year. Everything else sort of up over the year, maybe not as much as they were this year. But, sort of 2 years in a row, you've had very strong returns, in particular in the US and tech stocks. It's been a spectacular run for the last couple of years. And if you put the, pullback you've seen in the last couple of weeks or last few weeks, really, you can see the fact that, last year US equities were up almost 40% to December. And thus far, they're down about sort of 6 or so percent more recently at the bottom. So, the sort of pullback you've seen in markets, isn't that significant, especially when you consider over the last, few years, a couple of years, returns have been quite spectacular by historical standards. So what you've got on this chart here is calendar years of the S&P 500, so the US market in this instance. And basically, it just splits each year up into, was it a 0 to 10% year, a 10 to 20% year, a 20 to 30% year, etc. And you can see in this column here, 24 and 23 were 2 consecutive years of greater than 20% return for the US market. In fact, if you go back, the one next to that is 2021. So 3 out of the last 5 years were greater than 20% returns. Then in 2020, even the year of COVID, you had a greater than 10% return. And in fact, in the last 5 years, it's only 2022, which is over here, which has had, less, somewhere between a minus 10 to minus 20% return. So in the context of the last 5 years, you've had 4 years that were significantly above average in terms of market returns. So it's not surprising that so far this year, you've seen a bit of a pullback in markets. This is not unusual, especially in the context of the strong performance you've had over these last couple of years. Now, obviously, what that does raise the question about is, well, if markets have performed so strongly over the last couple of years, surely things look a bit stretched, valuations look extreme. Therefore, why would you want to come in now? And obviously, that has been something we've been talking about for quite some time in terms of when we construct the portfolios. And if you look at this sort of chart here, which is just a quick snapshot of valuations around the world, and if you want sort of more context around this, I suggest you watch the video from last week where we dive into the concept of valuation and what drives it. So, take this as a bit of a snapshot, but the concept being here is US markets were up 38% last year, so one of the best performing markets. Why wouldn't you want all your money in that basket? But you can also see there that on a forward PE basis, it sort of trades up 26 times earnings. So it's more expensive than other parts of the market where, for instance, Europe trades on 15 times earnings. So, 2/3 of the price or valuation of US markets. EM trades on 14, Japan around 16, Australia a little bit elevated above 20 relative to its own history. Now, in last week's presentation, we went into a little bit more detail. Just because the US is at 26 doesn't mean it's wrong. It all depends on the earnings profile, etc. So if you're more interested in that, certainly suggest you watch last week's video. But the point we're trying to make here is that, yes, it is, it's not surprising that after a strong period of returns that you start to see some, sort of, pullback in markets. This is not unusual, especially in the context of the last 5 years. You've seen a bit of a pullback in markets. This is not unusual, especially when you consider over the last 5 years, markets have performed so strongly over the last couple of years. overvaluation in markets, and in particular the US. But what you can see out here is outside of the US, other markets look a little bit more reasonable. We're not going around saying they're cheap, but they're not also overly expensive. They're kind of probably sort of fair value to slightly overvalued. And so what have we done within the portfolios we manage with Integro to manage some of this valuation risk? Well, you can sort of see here on this chart here, within the growth portfolio, we've been underweight the US and we've been overweight some of those other regions that look more attractive. And so what that means is when you think back to that first chart where in 2024, the first part of the year, it was tech plus a few other countries doing pretty well. And then the second half of the year, it was all about tech. When you look at our returns for the growth portfolio, you can see there in the first part of the year when all markets were kind of rallying, we were performing in line with markets slightly better. Then in the second half of the year, when tech started outperforming all the other markets, we slightly lagged on the way up, which is not surprising because we were underweight the US, which was the best performing market. Now, if you sort of fast forward to this year, you can see the opposite of that happening, right? So you can see that the US has been the underperformer relative to everything else. And therefore, because we're underweight that, we've managed some of the risk. So some of the things we can do within portfolios, we've tried to mitigate some of that valuation risk. And that's what we've been doing within the portfolios we manage to sort of, think around some of those scenarios around overvaluation in certain parts of the global economy.
Thanks for that overview, Phil, and great for clients who have been invested in markets and in these portfolios who have seen that uplift over the last couple of years. What we want to focus on today might be investors who have had a liquidity event or have surplus cash and want to invest that into the market. And with the recent volatility, might be hesitant in terms of entering into the market, possibly looking to hold off and wait for the market to continue to fall to lower levels and looking to time into the market at the lowest point. What sort of ideas or strategies would you consider around clients or investors seeking to pick their entry point at the lowest part of any particular market correction?
Yeah, I mean, look, timing markets is notoriously difficult. And one of the things we talked about last week, which I'll reiterate, is this slide here, which shows Warren Buffett, who's one of the most successful investors in the world, his cash holdings in his vehicle, basically Berkshire Hathaway, which he manages. And you can see here he started increasing cash reserves pre-COVID, and even he took a bit out of during the dip in COVID, but then even post-COVID he started increasing his cash reserves. And since that time, the market's rallied 50%, right? So even some of the most successful investors in the world don't necessarily have the ability to time markets. Now, notwithstanding the fact, Warren Buffett's one of the richest men in the world, so he can probably afford to wait on the sidelines and hold back and wait for a 1-in-7-year event to redeploy that cash. But if you're looking to generate returns over the from sort of starting point now to the medium term to the long term, you can think about this chart, which we also talked about last week, which is, this just shows you the last 15 years calendar year returns of different asset classes in each calendar year. And you can sort of see here, the first point we make about this chart is that you need diversification. Trying to pick the best performing asset class in any given year can be a bit random. The one that performed well last year isn't necessarily the one that performed well the next year. The second point we make with this chart is that, some years like 2022, yes, sitting in cash was the best place to be. You can see there, and markets were down sort of anywhere between 10 to 20%. But outside of that, over the long run, you can sort of see there, if I drew a line halfway through the middle of this chart, the grey bars, which are cash, tend to be in the bottom half of the table rather than the top half. And the point that this chart sort of makes is, first of all, you need diversification, but second of all, over the long run, you kind of do get rewarded for taking on risk. And so sitting there trying to wait for that, sometimes it might be 1-in-5, it might be 1-in-7, it might be 1-in-10, it might be 1-in-12-year market pullbacks can be difficult. There's no one who's demonstrated successfully of knowing exactly at which point that can happen. And the second point I would make around this is that, there's plenty of studies have shown that if you miss some of the best trading days in the market, your returns tend to be lower. So, the old adage of it's time in the markets, not timing the markets, kind of perhaps holds a little bit here. But if you miss sort of some of the best trading days, which can quite often happen after a significant drawdown, your portfolio levels can be significantly lower than if you just stayed invested throughout the course of history. The other chart you can look at is this one, which is if you look at investing in the market, what's the probability that you make a negative return over set periods of time? And so you can see on this chart here, if you're invested for one day, it's a bit of a coin flip. Half the time you make money, half the time you lose money. If you're invested for 1 year, 75% of the time you make money, 25% of the time you lose money over that 1 year horizon. So if you're unlucky 1 in 4 times to pick the peak and then suffer that drawdown, yes, you're in the 25% of times where you might lose money. But if you actually go all the way out to 10 years, irrespective of your starting point, more often than not, you make money, a positive return rather than negative return. 95% of the time, roughly, you make positive returns. And so you got to think about the fact that, being in markets is risky. No one wants to invest at the peak and then suffer a drawdown. But what this following table also shows you is saying, okay, well, post a drawdown, what is the subsequent return? So these are sort of drawdowns that are greater than 20% for the US market in this case, because it's got a long history. But you can sort of see there 1 month after a significant drawdown, typically the average return is around 13%, but you kind of go out 3 months, 6 months, by 1 year. 1 year after a significant drawdown, the returns are typically 48%. Now, that said, no one wants to necessarily come in at the top only to lose their money, only to make it all back again. You'd rather try to avoid that if you can, obviously. But it's as some of those other things have shown, it's pretty tricky to try and time out of markets.
So very hard to pick the bottom as your entry point into the market, as Phil's gone through there. But as he also mentioned, nobody wants to go into the market at the top and suffer an early drawdown. So Phil, can you share any strategies or concepts that an investor might employ to manage that sequencing risk going into the market from surplus cash or sale proceeds from a business or something like that?
Yeah, certainly, Bryn. I mean, obviously, this isn't sort of advice per se, but these are commonly deployed approaches to sort of manage some of that sequencing risk. And the first thing to think about is ensuring that you're in the appropriate risk profile for your personal circumstances and your risk tolerance, right? So some people have very low tolerance to accepting market volatility and risk. Other people are very have a high tolerance to accepting risk. And obviously it's evident through society because some people love gambling and some people don't, right? So some people are inherently bigger risk takers, others are less risk takers. So that's one thing, is you've got personal biases that can mean you're more or less susceptible to wanting to take on risk. And then the other part is whether you have the capacity to take on more risk. So that might be around your longevity, your personal health circumstances, how much capital you have, and how much volatility you can weather, how much income needs you've got, etc. So part of the way you manage this is ensuring that you're in the appropriate risk profile. And you can see on this chart here, what it shows you is a sort of typical 30% growth risk profile, a 50% growth profile, 70% growth profile, and 100% growth profile, right? So these are different risk profiles you could deploy. And what it shows you over time here is, as you would expect, the 100% growth profile, which is 100% in markets, in significant downturns. You can see here the GFC 2008, that 100% growth profile would have lost about 40% of its money. But as you'd expect, a 50-50 only lost 20%. And you can see the 30-70 sort of lost less than 10%. And, that was one of the most significant events we've seen in the last 50 years. And you can see in other sort of less significant drawdowns that, the 50-50 has only lost sort of 5%. So having the appropriate risk profile is one mechanism through which to ensure you aren't fully exposed to markets and don't suffer these significant drawdowns. The second strategy to deploy when you're coming from a position of a starting cash position is the concept of dollar cost averaging. So what does this mean? Is it basically means you don't put all your money in at one point. You establish a strategy that you're comfortable with and a time horizon over which you say, well, maybe it's every quarter we're going to put in a quarter of the cash every quarter, or every 6 months. We might do it over 2 years, or however long it looks like. So now the thing you got to think about with the dollar cost averaging strategy is it can actually work against you. If the market's going up, and using this chart as an example, and you deploy here, here, and here, and here, you would have been better off just sticking all your money in at the start, because your entry point was much lower, and therefore you've generated higher returns. Whereas if you only had half your money in, you only generated half the returns, and the rest is sitting in cash. So your weighted average price is more like here, as opposed to the starting point here, right? So if markets go up, dollar cost averaging kind of actually works against you, but it also has meant you didn't have to sort of try to figure out when to enter the market all in one hit. However, where it does come into effect is obviously if you entered at this point and you put in a quarter here and a quarter here and a quarter here and a quarter here, obviously what you can see there is as the market's been falling, you've been averaging into the market, and your weighted average purchase price is here. So yes, you didn't pick the bottom, but nor did you put it all in at the top. And then ultimately you're relying on markets to recover, but you don't have to make back as much if that was to occur. So, dollar cost averaging is a strategy that you can deploy to try to mitigate some of this risk. Obviously, its success depends on when you start, how long you do it for, whether markets actually do correct in that period of time or not. But it is a strategy that can give you a lot of comfort around deploying this. And what it also does is it gives you optionality, because let's say the market does all of a sudden crater, and okay, yeah, I've deployed half of my capital. At that point, you could decide, actually, I don't need to drag it out anymore. I could just put it all in at one go now, because I'm more comfortable with where valuations or markets are sitting. So it does give you a bit of optionality around managing that, inflow into the market, I suppose.
Thanks, Phil. From my perspective, it's important as an advisor that we understand the personal circumstances of clients, matching up their time frame for the capital that they want to invest to the types of investments that we might recommend. But great insights today. Thanks, Phil. And today's discussion contains general information only. As discussed, as an advisor, it's our job to take your personal circumstances into account. So please reach out to one of the advisors here at Integro Private Wealth so that we can take your personal circumstances into account and deploy a strategy that is more appropriate for you. But thanks again, Phil, for your time and for your insights today. Cheers.
Great. Thank you.
Bye.